Web video has grown up. Distinguish yourself with professional custom video for your business. Get started at johnlothianproductions.com.
What changes are being proposed to Rule 2A7?
Yeah, so if you look at the history of 2A7, 2A7 really was adopted under the 1940 Investment Company Act. And really what it was meant to do was provide a stable NAV product to money market mutual funds. So as long as you put $1 in, you can get $1 out plus interest. The reforms that actually were trying to be put in place were about creating a different kind of product. It was about creating a product that had either a floating rate NAV, a capital buffer, so if there were any credit losses, that the buffer would actually absorb that. Well, the third way they were thinking about this was actually holding back some money. So if you put $1 in, you might get 95 cents back right away and then hold the other 5 cents for a period of 30 days to make sure that there were no credit events in the fund.
What prevented the proposed rule from passing?
Well, in the end, the SEC commissioner did not have the votes to actually pass this. The money market industry was fighting back and lobbying very heavy, and she did not have the 3 votes to actually get this passed. So at this point, it is tabled. What I'll say is the battle's been won by the money market industry, but the war will continue.
What is the expected fallout from the tabling of money market reform?
The industry will go on right now as is. If you look at how money market funds work, it's a way for corporations as well as municipalities to fund their operations. So that will go on as is. The question now is what happens from the regulation side.
Do you see the FSOC as being part of the solution?
Well, if you look at the FSOC, there's members of the Fed, there's members of the SEC, and it's chaired by Secretary Geithner. So you have members who have already come out against 2A7 and really want reform in this marketplace. And they could basically decide that this marketplace, meaning the money market funds, presents some sort of systemic risk. They could also decide that a group of funds present some sort of systemic risk based on their size. So it remains to be seen whether they just push it back to the SEC to come up with some regulations and then try to push it through, or they work with the marketplace and try to come up with some sort of moderation. We don't know where this is going to go, but we know there's going to be a next step here.
What is the main driver of the money market reform movement?
If you look at what the SEC and what Ben Bernanke and what Tim Geithner were saying is that there's instability, there can be instability from these markets. And if you look at what has happened in past times of leverage like we've had, you take it back into the 1990s and inverse floaters made their way into securities and range notes made their way into securities. If you look into the 2000s, we had mortgage product and CDOs make their way into securities. And some of those ended up in money market funds. Well, they're actually trying to decide whether these funds actually pose a big risk or a big run on the bank sort of scenario to the system. And would those funds need to be rescued either by their parent, supported by their parent, or in the end supported by some other entity?
What other issues may impact the industry in the near future?
Something that we should be cognizant of in the overall marketplace is the debt ceiling. That's an issue that's going to come up at the end of the year. We also see that FDIC insurance could possibly expire. It is meant to actually expire at the end of this year. So what does that mean? When you actually have investors going to banks and expecting to get money back and guaranteeing that money, and all of a sudden you don't have that guarantee. Now, monies are guaranteed up to $250,000 no matter what. But after that, if it's in a non-interest bearing account, that money currently is guaranteed. After 12/31, as of right now, that may not be the case. As clients move to safety, as there's some sort of crisis of confidence in the macroeconomic world, money moves and it moves very fast. And return of capital becomes much more important than return on capital.